I think the 4.5% threshold is pretty serious.
How do we get to this point where a 4.5% on the 10-year is now in the danger zone?
If we stay up over 4.5% on the 10-year, the bond vigilantes will have their day in the sun, so to speak. Canada just can't disengage from the United States. Canada is economically part of the United States. Israel does not want the thing to be resolved. When it comes to the United States and Israel pretty much calls a tune on international policy as it affects the Middle East.
On Monday, June 1st, Iran halted negotiations with the U.S. and is moving to completely block the Strait of Hormuz, they said. Meanwhile, in the U.S., the share of credit card balances 90 days late hit 13.1%, the highest since 2011, and the savings rate has collapsed to 2.6%, the lowest since June 2022. Washington just ran a $955 billion deficit in the last 7 months, and the U.S. 10-year Treasury yield has moved to what HSBC calls the danger zone. So is this term reflective of the broader economy? Is this it? Are we now in the danger zone? Steve Hanke, professor of applied economics at Johns Hopkins University, is our guest today, and he's here to answer these questions and much more. This video is sponsored by Kalshi, the largest prediction market in the United States. Unlike a sportsbook, you're trading peer-to-peer on real-world events, from economic data to political outcomes, and the price moves based on a public opinion, not a house. Go to the link in the description down below or scan the QR code here and use my code LIN, L-I-N. New users who use my code will get $10 when they trade $10. Right now, traders on Kalshi are predicting that the next jobs numbers will beat the Wall Street consensus. For example, you could put $50 down on the jobs numbers exceeding 90,000 in May, and if you're right, your trade could yield $89. Link down below or scan the QR code here. Professor Hanke, welcome back to the show. Good to see you again.
Yeah, good to be with you, David.
It looks to me like consumer credit is deteriorating in terms of health. We'll talk about that soon. But first, I want to get your opinion on this announcement. Trump claims, the Iranians have suspended peace talks, and they threatened to permanently close the Strait of Hormuz. This according to many news outlets. I have the FT in front of me. Donald Trump said Israel and Hezbollah has agreed that the shooting will stop, but this is after Iran suspended its peace talks with the U.S. in response to the Israeli bombardment of Lebanon. This came in just earlier today. The oil price hasn't really spiked much on the news. It's still hovering above $91 a barrel. But is this just rhetoric from Iran? You think they're going to permanently block the Strait of Hormuz? So that's it?
No, I think it's very clear from the Iranians have basically said they're tired of being jerked around by Trump and dealing with the way he negotiates. That's the bottom line. I mean, they've been getting jerked all over the place. Every day, Trump has some new announcement. He's going to do this, that, or the other thing. And of course, in the background, you've got Israel pulverizing Lebanon and completely breaking any idea of a ceasefire. I mean, this is now the fourth time in the last 44 years that Israel has invaded Lebanon. And of course, the first three were huge failures. I think this will be a failure too. But remember, Lebanon and Hezbollah, that's a red line with the Iranians. No one's been talking much about that. So I think with that going on in the background and the Israelis wanting the war to continue clearly, and the Israelis whispering in the ear of Trump that they want the war to continue, and Trump playing hot and cold with the negotiations, I think the Iranians just finally threw up their hands and said, for now, let's call it a day.
So I think where I'm going with this is it fair to assume that because the Strait of Hormuz won't be opened anytime soon, given what this announcement indicates, we can expect the rest of the world outside the U.S., which depends on the Strait of Hormuz, particularly Asia, for oil imports and whatnot, to experience some sort of slowdown as prices continue to rise. And it's not just oil prices. For example, you posted on X that the price of rice has now risen to 2025 levels. And of course, a basic commodity like rice, which is consumed by billions, literally billions of people around the world, that's not going to be good for consumer spending elsewhere.
Yeah, all of this, functionally, the strait will remain closed, and the prices of this kind of supercharges what I think is the start of a super cycle with commodity prices, all of them going up. It's just not, you mentioned rice. I had an X on aluminum today. Aluminum is, but right down the line, all the commodities are up strongly. And remember, we have to get the sequence of the thing right. It was the U.S. and Israel attacked Iran, and Iran is counterattacked. The closing is just a counterattack. They're reacting to the attack that the U.S. and Israel had on Iran. So the causality, who's causing this? It's clear that the United States and Israel are inflicting a lot of pain on the world as a result of their war of choice against Iran.
Why aluminum?
It's a fairly simple thing. It's not reported that way. Of course, in the Western press, they report it as if all of this is caused because Iran has shut the strait down. Well, Iran has shut the strait down because they were attacked. And the only way they can effectively counterattack, or at least one of the ways they can counterattack, is to control the strait.
Okay, I have a few follow-up questions on that later, but why aluminum? You said aluminum may be the next commodity squeezed by the Hormuz crisis.
Well, because you've got a lot of aluminum production in the Gulf nations.
Yeah.
So at the margin, it makes a big difference. I mean, that is in all of this commodity basket of everything going up, whether it's lithium is going up, vanadium is going up, helium is going up, rice is going up, and these food prices, by the way, will continue to go up because remember, we've got a huge amount of fertilizer is being affected because of the shutdown of the Gulf and the Strait. So without fertilizer, you're going to have lower yields on many agricultural products, and with lower yields, you have lower supply, and with lower supply, you're going to get higher prices.
What can consumers in North America expect for higher prices? What in particular will go up? So you mentioned some commodities, rice, but not everybody eats rice. Can we expect general grocery prices to go up?
Yes.
Okay. Airline tickets are going up, I know, right? Because of fuel prices.
Airline tickets are going up because jet fuel prices. Jet fuel is a big cost factor with airlines, and the jet fuel is going up in price. And it looks, even though the refineries have switched and are producing a lot more jet fuel as a proportion of the total production that occurred prior to the shutdown in the Gulf, it still is going to be in short supply. I mean, demand exceeds supply, and inventories of jet fuel are going down. So at some point in the middle of the summer, you're going to hit rock bottom with the inventories. When that happens, the price will really shoot up. So a lot of these prices, by the way, will, by the time we get into midsummer or late summer, with the closure remaining in effect, we'll have some sharp price increases in oil and other commodities that are affected with a shutdown in the Gulf.
Well, we've talked about inflation a lot. Let's revisit this. Inflation isn't going up because of the Strait of Hormuz being closed. It's going up because the money supply has been increasing, correct?
That's correct. And the money supply in the United States has been accelerating for the last 18 months. And where are we? We're at Consumer Price Index. The headline number is 3.8% a year. That's, almost double the inflation target of 2%. So that's why people are complaining so much. They complain when they go to the grocery store because they have to go to the grocery store quite frequently, or when they go to the gas pump because they have to fill their cars quite frequently with gas. And those frequent purchases hit them in the eye. They get sticker shock. They see that and they start complaining about these particular prices that are going up. But the overall index, the big basket of over 300 items, is going up at a rate that's virtually double the inflation target. So monetary policy is in a failure mode in the United States. And I'm giving it a failure grade simply because they haven't been able to hit the inflation target. We got to go way back before you get to a 2% level. As I like to say, David, the inflation genie is out of the bottle in the United States, and it's not going to be put back anytime soon. This will be with Trump and one of Trump's big Achilles heels throughout, at least in the foreseeable future. So that means maybe throughout a big chunk of his second term, he's going to have this inflation problem around his neck.
But Americans should understand that this is not Trump's fault per se, is what you're saying. Because yes, Trump started the Iran war by bombing Iran, and the Strait of Hormuz was closed subsequently. But the Federal Reserve and the money supply going up, that's not because of the Trump administration's doings.
Well, they're not helping it because we have a huge fiscal deficit, and the Federal Reserve has monetized. They've gone in December from quantitative tightening to quantitative easing, meaning that they're buying treasury bills and monetizing part of the money supply. So that is a factor. Another factor is that, of course, you've got Trump leaning on the Fed to loosen up, and the Fed has been doing that basically. And they've been loosening up by switching from quantitative tightening to quantitative easing. That's one reaction that the Fed has had. The other reaction is they have loosened up some of the regulations and the capital requirements on the banks, and as a result, the banks in effect have more firepower, and they're using it to increase loans in the economy. I mean, the rate of money supply growth that is contributed by commercial banks, which, by the way, is the most important part of the money supply, that's growing now at around 10% per annum. And remember, 6% per annum is a rate of growth in the overall money supply, Hanke's golden growth rate, 6%, that's consistent with hitting a 2% inflation target. So the commercial banks are in a situation where they have been deregulated, and that reduces the capital requirements on the banks, gives them some extra running room. They can make loans. In addition, the capital is increased significantly in the banks because it has nothing to do with Trump per se, but their profits have been very strong. So they've had a capital increase because of profit growth. So the deregulation, loosening the monetary policy on the banks, commercial banks, and the combination of strong profits and increases in capital, both of those things give the banks potential firepower, and to firepower to do what? To make more loans. And if they make more loans, that puts credit into checking accounts, and checking accounts are part of the money supply. So the money supply goes up.
How does the money supply increasing benefit us, the consumer? What is the mechanism with which the money supply increasing will make everyone richer? Well, does it not do that at all?
Well, I mean, it makes you richer if you receive a loan from a bank. You of course you have a liability. You have to pay the bank back, but the immediate effect is that your assets are increased. That's your checking account.
Can we expect
that's part of the
businesses
money
to
supply.
Can we expect businesses to have more liquidity because of this? And then if businesses have more liquidity, we can expect them to hire more, pay people more, etc.
Yes.
Okay. So overall then, are you still bearish on the economy? Because earlier we had talked about a recession by earlier I mean last year and the year before, and now the money supply is increasing. So will that negate any slowdown?
The money supply is increasing, and so nominal GDP, which includes a real component and an inflation component, will go up. It'll continue to be elevated. And if you look at all the high frequency data on financials and as well as real economic activity, so far so good. They look pretty positive. It doesn't look like there's a recession in the wings right now. Now that doesn't mean that people aren't aggravated, and they're aggravated because the inflation component of nominal GDP has gone up, and real wages are basically flat. They're not going anyplace.
By the way, this came in. Credit cards gone up for the regular American. Share of balance 90 plus days late hits highest mark since 2011. This comes in as the savings rate has declined to 2.6%, which is the lowest it's been since last year. So savings have gone down. Credit card late balances have gone up. What does that tell you about consumer strength?
Well, it tells me that consumers are, getting more leverage all the time. That's one factor, and the lower savings rate plays into something else in the economy, which is the trade deficit. And the reason we have a trade deficit, that's made in the USA because spending on consumption is greater than production. We're spending more than we produce in the United States, so we have a trade deficit. And if the savings rate goes down, that means what? Well, you're spending more of your income. You're not saving as much, so that keeps spending elevated. If spending is elevated, that keeps the trade deficit going. So we can see more of what we've been seeing recently, and that is elevated trade deficit numbers, which of course will aggravate Trump to no end, and it probably motivate more threats about tariffs and trade policies from the Trump administration. So all these things tie back one way or another, and you've got it ends up tying back to what's going on in the White House right now, because the White House is a big player in the economy. It's intervening in all kinds of areas, whether it's government spending, government regulations, insider deals, self-dealing with each other.
If we look under the hood, according to this article, the increase in seriously delinquent balances may not be driven by a wave of new borrowers falling behind. Instead, the New York Fed found that the share of credit card balances that became newly delinquent was little changed from a year ago, suggesting the recent trend may reflect deepening strain among borrowers who were already struggling. So
I think that's consistent with the fact that you have, while the economy is humming along pretty well, there's no recession in the immediate outlook. All the data look okay. The money supply is being goosed. Everything is being pumped up, but the consumer, the little guy, is doing what? He's being faced with higher and higher inflation, and if you look at his wages adjusted for inflation, they're going no place. They're probably going south a little bit right now, especially after the U.S.-Israeli attack on Iran and the closure or functional closure of the Strait of Hormuz. That is caused, actually, in the last few months, real wages adjusted for inflation have actually gone negative. They're not flat. They're actually negative. They decreased.
What's a recession these days, by the way? Let me bring our attention to Canada. Canada's economy is struggling. Rio GDP numbers were announced last week, dropped 1% in the fourth quarter. And 3 of the last 4 quarters in Canada have now posted negative real GDP numbers. That's on an annualized basis. So according to a TD Bank economist, don't get me wrong, the economy has struggled to gain any meaningful traction over the last year, but for now, we wouldn't necessarily call it a technical recession. I'm confused.
Well, there are many definitions of technical recessions. Usually the one in Canada would be 2 consecutive quarters of negative growth, which, as you indicate, they've had 3. So it would fall into mild recession. You can use the R word for Canada, but you've got Canada's been struggling. They've had over 10 years of the interventionist kind of liberal party economic policies, which have not helped at all. Very low investment rates in Canada, and then on top of it, you've had what? You've had Trump bailing, piling on with threats about tariffs and so forth. The Canadian economy is very tangled up and tied in with the U.S. economy. And as a result of all this tariff war between the United States and Canada, it's severely put a dent in Canada. There's no question about it.
Another economist, by the way, there's little debate that the economy has struggled to make any headway over the past year amid the ongoing trade conflict. How would you, let's say, I know you had previously advised the U.S. government in your career. If you had to make similar recommendations to the Canadian government, how would you advise them to, A, grow the economy ultimately, but B, I guess be less dependent on the U.S. if they were to expand their trade partnership?
Well, I'd say that the Prime Minister is doing a pretty good job of walking on the tightrope with regard to Trump and Trump's threats, and Carney has pivoted away as much as he can from the United States, pivoting towards China and Europe with regard to Canada. But the fact is that Canada is highly integrated with the United States, as is Mexico, as is many countries are. So the idea that you can pivot is true, but you can only pivot at the margin, David. You can't escape the whole picture.
Okay.
So my view is that Carney's I think he's doing a pretty good job given the fact that he's under severe threats by the United States, the Canada's biggest trading partner. It's a little bit like the same situation what's going on in Mexico right now.
Can the Canadian economy recover while tariffs are still ongoing, you think?
Well, I think the only way the Canadian economy can recover is by adopting a whole new game plan, shall we say, and in terms of deregulating the economy, lowering the taxes, keeping the Bank of Canada on the straight and narrow with inflation, hitting the inflation target, which, by the way, they're doing now.
Okay.
So it's basically they have to turn back the clock and start liberalizing the economy. What's slow? They have to stop doing what they've been doing for the last 10 years. To make a long story short, but this is going to be very difficult to do because of the liberals are in power. So they're playing a defensive game right now. They are trying to liberalize one thing, and that's trade. It's interesting. Their defense so far has been pretty good on the trade front. And what has that been? That's been to liberalize trade and move towards a more open and free market approach And who are they doing that with? They're doing it with China and Europe. They should adopt a more liberal approach to economic policy across the board.
Okay, so let's move back to the U.S. in just a bit, but given what we discussed so far, how would you assess global growth prospects across the world, not just in the U.S.? We talked about Canada. You mentioned Europe. You mentioned China. Are these areas set to grow at a faster pace this year than last year?
I think there'll be revisions downward in the growth projections.
Because of Iran or something else?
Yes.
Okay. So is it safe to say that the Iran war needs to be resolved for global growth to happen, or can global growth happen independently due to other stimuli?
Well, global growth could be would have receive a positive impact if the war on the U.S.-Israeli war in Iran was resolved in some way. I don't think that's in the cards, quite frankly, because you've got a spoiler in the mix, and that's Israel. Israel does not want the thing to be resolved, and when it comes to the United States and Israel pretty much calls the tune on international policy as it affects the Middle East. So that's why I'm quite skeptical that there'll be any reasonable resolution to the war that the U.S. and Israel started. By the way, the U.S. and Israel started the war, and I don't think the U.S. and Israel are going to stop the war. And the reason for that is that Israel doesn't want it to stop.
Should the U.S. stop?
Yes, but they aren't in control of the thing. Again, you've got three parties involved in the to stop it, and that's Iran 1, Israel 2, and the United States 3.
What happens if the U.S. just announces tomorrow, we're going to stop, we're going to pull out our Navy and just leave?
Well, we don't know exactly what the Iranian reaction to that would be, because the Iranians have certain demands for stopping, and one of those directly affects, by the way, Israel, because Israel is engaged in a war against Hezbollah in Lebanon, and part of the demands that have been made by the Iranians is that should stop. The occupation of Lebanon and the war Israel is waging with Hezbollah should stop.
Yeah. Okay.
So there's not there are just many moving parts in this, and to stop all the parts from moving, I think is going to take a great deal of effort that I don't see on the horizon right now. And again, one of the main reasons is that you've got one of the three parties clearly does not want the war to stop. I think the Trump administration would like to have it stopped, by the way. The U.S. would like to have it stopped. I think Iran would like to have it stopped. Both sides have different demands and conditions. And the third party does not want to see it stopped.
I think China also wants to see it stopped. There was a basis of the meeting between Xi and Trump last month. Right,
but again, I think everybody would like to see it stop on certain terms. The terms of Israel would be to wipe Iran off the face of the earth.
Well, that hopefully that doesn't escalate any further. Let's go back to the U.S. economy. You had written an article for Fortune. Let me just pull this up on the screen. Talking about, or warning us about the deficit growing. So the deficit grew by $955 billion in 7 months. It's time for a constitutional fix to control the budget, you wrote. This is expected to grow, by the way. That pace puts the full-year deficit on track to exceed $1.9 trillion, precisely the CBO's own annual projection. This is from Kalshi. It's a prediction market. Traders are predicting that there's a 33% chance the U.S. credit rating gets downgraded this year. It's not high, but it's not zero. What's your assessment? And why did you write a full op-ed about the deficit?
Well, I wrote a full op-ed about the deficit because deficits are bad. If the government wants to spend money, they have to tax. That's the bottom line. And the reason for that is that uh, over 20% of taxpayers' money that goes into the federal government is just siphoned off to service debt payments. A little over 20% is just goes for interest payments on the debt. So the taxpayer gets nothing for that. There are no income transfers to anyone. There are no government services financed with that 20% that gets siphoned off. It simply goes to bondholders that have bought bonds that have been used to finance the deficits in the first place. So it's literally like money down the rat hole. So that's point number one. Point number two is that deficits are really inherently, I think, immoral in the sense that a deficit is just a deferred tax. A deficit will have to be paid eventually, and it will be paid by some future taxpayer. That future taxpayer might be somebody who isn't even born yet.
Yeah.
And it could be somebody who hasn't even voted yet.
Right.
And we know it's going to be paid by older people. So for all of those reasons, I'm a classical economist that doesn't like deficits. They're bad news. They're bad economic policy if you run them on a sustained basis. Now, over the business cycle, yes, there might be years in which you run a deficit, but there might be years in which you run a surplus. And over the business cycle, from the start to the finish, the thing should be more or less balanced. That's a classical view, and that's my view. So how do you solve this? You get to a constitutional amendment where you put a debt brake in the U.S. Constitution, and require that the budget is balanced over the business cycle. You can't run these sustained deficits over and over and over again. You have to balance out any deficits that you have during the business cycle with years in which you have surpluses.
U.S. credit downgrade, then, is that going to happen this year or even next if this doesn't fix itself?
Well,
and by the way,
I think that poly market thing is probably reasonably accurate. There's roughly a 30% chance that there'll be a downgrade.
That means yields are going up.
Yeah, yields are going up. Yields are going up anyway because the interest rate is a function of the inflation rate. So yields on bonds, with the exception of the federal funds rate and very short-term interest rates that are controlled directly by the government, the longer-term picture is controlled by, in part, inflation and the risk appetite of, obviously, people who buy bonds. So if the risk appetite goes down because they think there's more risk inherent in what the government policies are, that could increase interest rates. But the main driver is inflation. So like the 10-year bond, you have to look at what's going on with inflation and inflation expectations. And I think they'll remain elevated. And that's why you've got the 10-year at almost 4.5%. I mean, it was up last week over 4.5% for a few days.
It was. Now, how high does a 10-year or 30-year need to go before the bond vigilantes basically force the U.S. government to somehow address their spending?
I think the 4.5% threshold is pretty serious, actually. I think if we stay up over 4.5% on the 10-year on a sustained basis, the bond vigilantes will have their day in the sun, so to speak. And the reason for that, you see, the negative feedback loop comes into this thing, David. If the interest rate goes up, we've been financing a lot of our deficits with short-term treasury bills, 2 years in duration or less, And as those things have to be rolled over. And if they're rolled over at higher interest rates, that 20% or a little over 20% of taxpayer taxes going to service debt will go up.
You're right on this. And by the way, you're not alone in thinking this, is what I'm trying to say. U.S. Treasuries are now firmly in danger zone, quote unquote, strategists say from HSBC. U.S. Treasuries are now firmly in the danger zone, the level of U.S. 10-year UST that tends to put pressure on virtually all asset classes, says a USB strategist. Even further into the danger zone, likely leading risky assets temporarily lower. Can you just explain how that works? For the layman investor out there, why do we care about where the 10-year is headed if you're into stocks or anything else?
Well, you mentioned credit cards a little bit earlier.
Yes.
The credit card interest rates are geared off the 10-year. Virtually everything is geared off the 10-year. How about mortgages? Mm-hmm. The housing market is very soft right now. And one reason for this are the mortgage rates. And if the 10-year goes up, mortgage rates are going up. If the 10-year goes up, credit card interest rates are going to go up. So it is a key interest rate to watch, because many other interest rates in the market are geared off what happens to the 10-year.
How do we get to this point where a 4.5% on the 10-year is now in the danger zone? Remember in the late 80s or early 80s when it was double digits, and then high single digits later on in the 80s and 90s. I wasn't born in the 80s, but can you just jot our memory here? Were people concerned about a 10% interest rate back then?
Yes, they were very concerned. But remember, when we talk about 4.5%, it's where we were coming from. The 10-year, just a minute. Let me just glance at my iPhone right now, and the 10-year, just so I have the numbers right for you.
Yeah, I can pull that up for you too.
Yeah,
I mean, we're at 4.5%. We were at zero. Basically, it troughed around 2020 at 0.5.
Yeah, and we were down. If we were down 2 years ago, it was down. Below 3.9. I mean, at the bottom, we were down around 3.7, 3.6, something like that. So it's always things at the margin. This is basic economics, and that is all the action. Everything that's important is at the margin. What's going on at the margin? And at the margin, the interest rates have gone up significantly, and it's biting. And if you look, we were talking about Canada earlier. I said, well, Canada just can't disengage from the United States. They're all tangled up with a web of trading relationships with the United States. I mean, Canada is economically part of the United States for de facto. So what can they do? They can, at the margin, you see what Canada's doing. Carney goes to China and cuts some deals. So at the margin, they're pivoting a little away from the United States towards China. They've cut some deals with the European Union. So at the margin, Canada pivots a little way away from the United States towards the European Union. But those are all marginal things, but that's where the action is, at the margin.
Okay. I want to finish up by talking about taxes. You brought up taxes earlier. You said deficits are bad, and what the government needs to do to address deficits, either spend less or tax higher. This is Jeff Bezos, by the way, Amazon CEO. He said, look, you're focused on the wrong thing. Raising taxes on the billionaires aren't going to help the teacher in Queens. You could double the taxes I pay. It's not going to help that teacher in Queens, he said. New York Mayor Mamdani later responded to this assessment. I know a few teachers in Queens who would beg to differ. Now, then Bezos made the point, which is what I'm getting to. He said, well, it's not that we should tax the billionaires. We should reduce the taxes on the middle class. So the bottom 50% should pay zero taxes. Let me just start with that, and I'll get your reaction to that statement.
Well, the ideal tax system in the United States, as far as income taxes go, is a flat tax. The Hall-Rabushka tax. My former colleague and collaborator Alvin Rabushka and Robert Hall put this up, and that would be a tax without any loopholes or anything of around 13% for everybody. Whatever your income is, whatever your taxable income is, 13%. You'd file your taxes, as they say, on a postcard. Get rid of the book after book of tax code. It would be a very simple thing, just a straightforward tax on everybody, 13% of taxable income.
Okay, so you're effectively making tax lower.
A flat tax. Let's say 13 to 15%. I can't remember actually off the top of my head the original Hall-Rabushka, but whatever the flat tax rate would allow the budget to be balanced. If the government wants to spend, they have to tax to finance it.
Right. So
it depends on how much they want to spend, and if everyone knew, by the way, they were going to be taxed at all taxable income at the same rate, whether you're Jeff Bezos, Steve Hanke, Joe Sixpack, you name it, everybody has the same rate. Then the question would be, well, what's that rate going to be to allow for a balanced budget? And people would have an honest price of what the government expenditures should be priced at. And if the government wanted to spend a lot more and the tax rate would be 20%, maybe there'd be a tax revolt and they'd say, no, we don't want you spending that much. We want you spending something to dial it back. So we pay a tax rate of 15%.
So let's suppose
it gets some honesty in terms of pricing the government and pricing the government services. If you had a flat, transparent tax, it would do wonders for the supply side of the economy, productivity in the economy, and fairness in the tax system.
Okay, I'll let you explain how that would do that. To Basil's point, why shouldn't we have a tiered system that's more extreme? Let's suppose we take your system, the flat tax system, whatever that number is, let's say 15%. And just for the sake of argument, that generates $1 trillion in tax revenue, just to make it a round, easy number for the argument. Now, we can generate $1 trillion with a flat 15%, or we can generate $1 trillion by having 0% tax on the bottom 50% of earners and then just raising taxes on billionaires. Wouldn't that be the same thing for the government, but make most people better off?
No, number one, you would put a huge dent in the savings investment activity in the United States if that was a kind of progressive system that you had. You get the same kind of effect that you have in places like California and New York, where they do have very high taxes. Also in Maryland. Maryland has very high state tax that's added to the federal tax. And as a result, all three of these states are losing population. Why? Because people don't want to be taxed that much. They go to Florida or Texas or some other state where they have lower tax rates. So, their incentive effects. Economics is, remember, all about incentives, and there are incentive effects associated with the tax system. So that was the idea behind the flat tax in the first place. It was a hallmark of supply side economics. Came out during the Reagan years, Reaganomics, and the idea would be that you'd have a flat, low tax on everybody. That wouldn't affect savings and investment work or too much because it would be relatively low.
Right. Are you saying we shouldn't tax the corporations and billionaires more, because if we do, they will move away and then the jobs in those areas would disappear, and so everyone would be worse off even if they pay a lower tax rate? By they, I mean the lower income earners?
Yes.
Okay.
And it's just because of the incentive effects. you start distorting investment decisions, savings decisions, location decisions. But if you have a flat tax that's low, you don't. It's not onerous, so it doesn't affect much of in terms of the incentive effect is mitigated, shall we say, if you have a low flat tax. So the supply side distortions that you get in the economy, David, are mitigated. You basically don't screw around with the economy because you're screwing around and distorting incentives.
Finally, let's just talk about jobs. Jobs numbers in May 2026. Traders on Kalshi prediction market indicate that May's jobs numbers will top Wall Street expectations. This is from CNBC. Dow Jones estimates that May's non-farm payrolls reports will gain 90,000 jobs. The consensus reflects an anticipated decline from April's 115,000. However, Kalshi traders, prediction market traders, are citing a 56% probability that the report will beat the Wall Street forecast. You've talked about how prediction markets have been accurate in the past. I don't know why traders are so positive on the economy, or at least on job growth and jobs growth in particular.
I wouldn't place too much money on these numbers because remember, the numbers are very fuzzy. They're revised all the time.
Yeah.
And the revisions, by the way, the revisions are supposed to correct errors in the first estimate that comes out, but the revisions themselves sometimes have errors that are even bigger than the errors that they were trying to correct in the first place. So all of these numbers are just all over the place. It's not the kind of thing that a seasoned economist would want to be betting on, to tell you the truth.
Professor Hanke, thank you so much. We'll stop here today. Tell us where we can find your work, and please
you can follow me, David, on X at Steve_Hanke.
Okay, good.
That's the best place. Or as I indicated before, and a lot of your listeners have contacted me, just send me an email, hanke@jhu.edu, and I'll put you on my weekly distribution list.
Good. We'll put that down below, and as well, feel free to send Professor Hanke an email or myself if you have questions for Professor Hanke. He's a regular on the show. We covered a lot of topics today, but we're always welcome to your own ideas as well. Thank you so much, Professor Hanke. We'll speak soon.
Well, thank you, David. Great to be with you. Have a great evening.
Thanks for watching. Don't forget to like and subscribe. And don't forget to follow Professor Hanke in the links down below. And finally, don't forget to use my code LIN, L-I-N, when you sign up to Kalshi. New users who use my code LIN, L-I-N, will get $10 when you trade $10. Link down below or scan the QR code here.